Hello, everyone. It is December 30, 2022. This is the last day of the trading year for 2022, and we will be discussing today how Tesla caused a short term bottom in the US markets, which will probably have an impact in the very short term, let's say 1 to 2 weeks. And of course, we're going to discuss the energy bull run and our 2023 outlook. Happy holidays, everyone. I'm sure some of you guys are abroad or you're at home. You're celebrating with your family for the upcoming New Year holiday. So I do wish everyone well, and thank you for those who are watching, whether our recorded session or our live streams. For those who are in the chat, just go ahead. If you have questions, please type it in the comments. And this is Nikki wishing you well in the holidays. And thank you for, of course, supporting at Faces Trader and Awesome 10X Investing. All right, so let's go ahead and discuss the markets. Okay, the markets are still open for tonight. It's going to be the last trading day of the year. And today's Tesla short term bottom indeed causes a year end bear market rally, and the energy bull run continues. December 30, 2022, we saw actually a short term capitulation bottom for Tesla last night, which was December 29, 2022. I saw this on Twitter. This is by Mark Douglas, and I wanted to share it because for the new year, if you're going to be watching this for your 2023 outlooks or for your 2022 year ender, I do believe that this is something that would help all of us. So we're just going to read it as if it's the Bible. Okay, wait up. I'm going to share the entire screen here. Wait up. All right. Okay, so the fundamental truths of trading: number one, anything can happen. Number two, you don't need to know what's going to happen next to make money. Number three, there's a random distribution between wins and losses for any given set of variables that define an edge. Number four, an edge is nothing more than just an indication of a higher probability of one thing happening over another. And number five, every moment in the market is unique. Now, the seven principles for your consistency is: number one, objectively identify that edge, predefine the risk for that trade, completely accept the risk, or I am willing to let go of the trade, no freezing. I act on my edges without reservation or hesitation, no excuses. I pay myself as the market makes money available to me, which means that if you do make money, if you want to withdraw, yes, you can pay yourself, lock it in. I continually monitor my susceptibility for making errors, which means that we are human. We should accept that we can, will, and we will make mistakes. Number seven, I understand the absolute necessity of these principles of consistent success, meaning we do have to trade a system and edge. Therefore, I will never violate them. Or if we violate those rules, then we get to actually pay the price. So my advice for 2023 is, well, we want to keep our bear spreads, but we can actually take some profits partially. The key thing to note about your bearish spreads is to monitor the expiry. If it's a long-term short, we're talking about February expiry, March expiry onwards. You don't need to manage that trade. That can have drawdowns, but it will still be part of your rules to keep those long-term shorts. Now, you do have to remember to take profit on your credit spreads past 50%. You do not need to wait for expiry dates. It's December 30, 2022. Let's say you entered into some bearish positions by selling credit spreads on your bearish calls on Nvidia. For instance, for us, it's already past 50%. So I would assume that you should be collecting your profit and not letting it linger onwards, whether your expiry is January 6, January 70, 2020 plus. Remember to take profits on your debit spreads past 100%. No need to wait for expiry dates. Well, that is a systemic rule for us to take profits on your bearish debit spreads if it's past 100%. Nonetheless, you can actually modify. Some people wonder if they can actually take profits even if the debit spread is just 30% or 40%, simply because last night, indeed, Tesla may have made a short-term bottom, which may actually affect your bearish debit spreads, not hitting the 100% moves. So you can actually profit take partially. Now, number two, if you have inverse funds and if they fall, you can actually do the following. Well, you can add on your inverse funds if the S&P hits 4,000 or near 3950. You can buy or cost average your semiconductor shorts if it's actually below 35. You can cost average your financial shorts if it's about 18 to 16 areas. You can also cost average your QQQs or your NASDAQ shorts if it's actually 45 or lower. Just remember that you trade the ranges. We're also going to show to you how to actually own some bearish spreads or some inverse funds while also having some bullish spreads with, say, NVIDIA. So you don't need to actually just play one side. You can actually hold your side on your inverse funds. So, for instance, a lot of people may own some SOX S, so they have a long position on SOX S, but they can actually close their bearish spreads on Nvidia and then start a bullish call spread for Nvidia, or make selling credit spreads on Nvidia, which we'll actually explain today as well. So if you will play the bullish spread, we think that you consider your holding period about 1 to 2 weeks. Don't overly play the bounces because we are still in a bear market. Now, you want to actually stay long the energy market. If the market falls or rises, our outlook is that for 2023, energy likely stays the same or mildly bullish. If it's neutral to bullish. So stay mostly long energy all throughout the year. So if you have longs on the energy, you want to keep them intact. You want to hold on and roll it over for the next year or next few months. When I talk about energy, I'm talking about Diamondback Energy, ticker symbol FANG, SM Energy, ticker symbol SM, ExxonMobil, we're talking about XOM, Chevron, which is CVX, Shell, which is SHEL, Sandridge Energy, SD, these are shale companies, APA Corporation, APA, BP, which is BP, ConocoPhillips, COP, Total Energies, which is TTE, BP for the UK there, British Petroleum, PLC, EOG Resources, which is EOG, Phillips 66, PSX, Chesapeake Energy, which is CHK, Occidental Petroleum, OXY, Matador, which is MTDR, Vermilion, VET, Devon, DVN. We have covered the fundamentals of why energy are longs, and we're not going to go through today's topic about why they are longs. You can actually try to check out our ideas on why Vermilion is a long, why Equinor is a long, why APA Corporation is a long, why energy sector is a long. Now, the latest news for those who aren't in the know is that energy rose more than 1% last night, shrugging off the weakness in oil prices, following the data showing that the weekly U.S. crude stockpiles are actually rising by 718,000 barrels last week. That confounded expectations for a drop of about 1.5 million. Now, you're seeing also that energy longs are still our best trades for the next year, which is 2023. I will show to you all the charts for your energy longs. I actually already tweeted it in our Faces Trader. And then, of course, for those who haven't opened their accounts, please take note that in the thumbnail, you already have my Webull referral link and my IBKR referral link. For those who have no accounts yet, please try to open through our thumbnails. We already already uploaded what our referral links are, just to have just to help you also get your $150 free voucher. Once you open a $2,000 account with Webull, that's a Christmas promotion. I think they're extending it for January. And then for IBKR, I believe that you'll get about $100 worth of IBKR shares if you open an account. I don't know if the minimum is $2,000 or $10,000, but you can check the referral links because it's all contained there. So a lot of these stock accounts, brokerage firms in the US are still offering a lot of these really good promotions for you to actually open your US market accounts. Okay, so energy longs for 2023. I know this may be obvious, but any pullback will still be on the buyer's bias. So let's take a look at the famous shale and oil and gas exploration and drilling companies in the US. This is Marathon Oil Corporation. You can see that I just simply drew a 200-day moving average line, which tells you that for the entire 2022, these have been in major uptrends, and therefore we aren't going to be saying that they will reverse anytime soon. Fundamentally and technically, they're actually still in the running for next year's best performing assets, which are your oil and gas assets or your commodities. This is your EOG. You can see that for this entire year, it has been a strong uptrend and dips have been a bias to buy. Same thing for 2023. We expect any dips of EOG from 130 all the way to 115 to still be on a buying round. Okay, we're talking about Devon Energy here. You can see also from the chart, Devon here at 60 or 55 are all buying opportunities. Here for your Occidental Petroleum, one of Warren Buffett's biggest holdings today, at $60 and $50, 55. All of these are still opportunities for entry points for next year. Hess Corporation here at about 130. If we get an entry there, 130 all the way to 120 are still buyable opportunities. Look at FANG, aka the Diamondback Energy, here about 136 to 120. These are opportunistic entry areas. So Cotera Energy here at about 24 is okay for an entry. Right now, I'm just going to talk about the price levels. We're not going to talk about fundamentals. As I said, you will have to go to industry reports or sign up on Awesome 10X on why energy bulls are even a great long-term buy. Or in our case, what we're talking about long-term is good for 2023 or next year. SM Energy Company here at $34 is still also a buying area, even as it goes towards $31. All right, here for Matador Resources, here about 55 to 56, 57 are entry opportunities. Here for your US oil, you can actually buy $75, $78. Any price near 70 to 77 is a buyable play. U.S. strategic petroleum reserves are buying. The OPEC supply is also trying to lessen the production. You've got the China reopening also adding into your demand consumption. USO for those U.S. state oil funds here at about $68 is an entry point. XLE, the famous sector for energy stocks for the U.S., it's still a buy here at $87 or $80. Any dips below 80 would be an opportunity for another entry point. You've got Energy U. This is more volatile. This is the triple leveraged oil index fund, which means that for about $450 to about $400, that would be a good entry idea, but it's going to be quite volatile for those who are going to trade inverse funds such as Energy U. Let's take a look at your XOM. This has been a smooth operator this year, going from $60 to $120. Any dips near 100 below is going to still be an entry point for your largest and most profitable oil and gas exploration and driller for the year, which is ExxonMobil. You've got Chevron. This is also a buyable area. You can see from 110 to 180. This was also a smooth uptrend. Any drops near 150, 160 would still be an entry point for your Chevron. ConocoPhillips, again, one of the largest oil and gas suppliers in the world, is also a buy at 110 below. You've got companies like Sandridge Energy, a small cap shale company, here at about $16, even at $14 would be an entry point. For those who are looking for more shale companies, Vermilion Energy here at about 17 also is in your buying zone. You've got APA Corporation at 45 in the buying zone. You've got essentially a lot of energy longs. Yep. All right. So you've got some catalysts in the short term. Of course, everyone sees China reopening to be a boost towards consumption and demand. Therefore, that would bring about more oil demand, which means that your China reopening is very positive for the oil bulls out there. At the same time, the U.S. is buying oil for strategic petroleum reserve. The U.S. Department of Energy on December 16 announced that they would be securing a good deal for taxpayers and to strengthen their energy security by using a fixed price replenishment. So the DOE, or the Department of Energy in the U.S., said that they will start repurchasing crude oil for the Strategic Petroleum Reserve. That will put a bid actually for your oil prices to stay above $70. So they're going to be using the opportunity to make a good deal for American taxpayers, purchasing oil at a lower price than the $96 per barrel average price that it sold for. So basically, they're trading oil. They sold 96. They want to buy 70 to 80. They can make a 20% or, something to help the Americans. So the president announced that they have a plan to replenish the SPR, or the Strategic Petroleum Reserve, allowing for fixed price purchases of crude oil. And this approach will actually assure that the investments they do today, knowing the price they receive when they sell to the SPR, will be locked in place. This is to start a purchase of up to 3 million barrels of crude oil, starting actually there. So actually, they said that on December, they'll start that for 2023, January until February. So they'll be just basically buying up oil. Now, another thing to also understand is that the Nifty, or India, is closing in near the highs for the year. And more importantly, Nifty 50 index actually is quite an outperformer despite the entire market actually succumbing to massive sell-offs. You'll notice that this index of Nifty 50 went from 8,000 to 18,000, nearing 20K. Now, I'm not here to actually say that I know anything about India. In fact, I don't know Indian markets. Nonetheless, a lot of people who are into the Indian market are saying that most of the factors that had made India resilient has been government reforms. The factors supporting Indian market despite global uncertainties is that they have an economic growth, recovering GDP, domestic investors. Of course, we know 1.4 billion of Indians are about to surpass China's population. Demographics might play the more important role for consumption demand. Now, the direct incentive from the government has also imposed positive sentiment among foreign investors, considering India as their next investment arena. So it's the beginning of a new corporate capital expenditure cycle, a lot of better operating margins. Some of the leaders in India were Reliance Industries. Some of their oil and gas metal indices also up 20% for the year. Their Coal India, Mahindra and Mahindra, all handsomely rewarding 50%, which means that basically coal, oil, gas names, whether in India, USA, even in the Philippines, would all have been on an uptrend, as general coal, oil, and gas prices have been on an uptrend. Now, let's also explain, of course, today's topic, which is we are seeing growth stocks beaten down, happening to actually make a short-term bounce in oversold conditions. We are actually seeing Tesla, Apple, Amazon, Roku, Palantir, Shopify, Sea Limited, Square, Airbnb, all actually showing some positive signs last night of a potential either short covering rally, or is it really the reversal? Now, actually, I am suspect of this being a real reversal. Nonetheless, guys, am aware that this is a tradable bullish bear market rally for these growth names. So I think that ARK at about $30 is in a bullish site. And you can see that currently, all the growth names that are battered and beaten down, in our system and options, we are seeing that it's actually systematic to be bullish on your Tesla, Amazon, Google, Apple, Nvidia, whereas your dividend names like P&G, J&J, Pepsi is actually even overvalued, that it even makes sense to make bearish put spreads on them. So far, the middle side like Microsoft, Home Depot, Costco, we are not of any view. We're just neutral on them. So the short-term bounce buy list for December 30, 2022 is, you can actually make a trading play to buy Sea Limited here at $50, buy Tesla here about $120, buy Roku here at $40, buy Palantir here at $6, buy Shopify at $35, buy Apple at $125, buy Amazon at $80 to $85, buy Airbnb $80 to $85, and buy Square at about $60 to $63, aka block. Now, aside from buying the shares, we have also explained to you in our recent videos, explain options like M5, how to generate income in a falling market or in a rising market. The point is that you can make option spread be in your favor. So for instance, if I want to be bullish on C Limited, I can automatically sell OTM or out of the money puts. You can see that the price of C Limited is currently about 50 to 53. I could sell actually 45 puts and buy 40 puts and receive $105. And the reason why it's negative is because if you buy with a negative 1.05, IBKR will say that you are getting a credit. You are not paying, you are receiving. You can see that all of these buys are actually credit spreads, which means that I am receiving. If you buy a negative 1.05, that means that I am receiving $105 per contract on C Limited. I am receiving $190 for every contract of Tesla bull spread. Amazon, I'm receiving $103. Palantir, I'm receiving $35 for every contract. Roku, $353. Apple, $111. Nvidia, $392. You'll notice also that the risks here are dependent on the spread. So if the C Limited credit spread is 105, that means that 3.95 is the risk because this is a $5 with spread. If this is a $5 with spread for Tesla, it's also obvious that $1.90 Tesla bull spread is actually giving a higher. You'll notice that for the same $5 spread, this one is giving 190 with a risk of 310. This is giving 105 with a risk of 395. This is giving 103 with a risk of 397. So far, amongst like Tesla, Amazon, or Apple, it still is Tesla that is quite the oversold one if you had to choose only one. Now, amongst Palantir, C Limited, Roku and Nvidia, although they passed the credit spread test, what we're simply saying is that, yeah, you can actually make money like selling some Nvidia combos here, selling 145 puts and buying a 135 put to just basically cap your downside just in case you're wrong. So you receive about $392 or about $400. You can even try negative 4.5 limit to receive $450 on your NVIDIA combos. And then basically what you're just waiting for your money, this is February 2023, is for the stock, say C Limited, to stay above 45, you win. Tesla above 115, you win. Amazon above 75, you win. Palantir above 6, Roku above 40, Apple above 120, Nvidia above 145. Now, if we're going to be nitty-gritty about this, technically speaking, 45 minus 1.05, your real break-even is how much? It should be 43.95. 115 minus 1.9, that's about 113.1. So that's really your break-even price. But generally speaking, when you're selling credit spreads, all you need for the money to be made is so that it just remains above your sell put strikes. That's about it, and that's why it's such a forgiving strategy, which is why a lot of people undoubtedly love selling credit spreads, because you sell credit spreads, you receive all these premiums. Usually, people like to sell high IV. When you say high implied volatility, you can see that there is high implied volatility in Tesla compared to an Amazon. That is 190 being given. This is just $1. This is just $1, which means that the Tesla bull spread still is double the usual credit spreads being given versus, say, an Amazon or an Apple. So that just illustrates to you guys how outlier Tesla is. Now, you can see also that from the TSLQ, or the Tesla Bear Daily ETF, you can see that all the shorts have already ran up from about $36 here for AXS TSLQ to about as high as $90 here, near 92. So we see that big sell-off last night, indicating to us that if this is falling down, since it's the bearish daily ETF, that means that your Tesla on the long side has finally found its bottom. And more importantly, Tesla seems to have bottomed out, at least in the very short term, with the highest trading volume day for 2022. You could see that on December 27, that was 200 million. And you'll notice that the other dates from 22, 23, and 20 had super high volume of shares, which gives us that Tesla has actually a huge vacuum point from $105 to as high as $150 to $160. Now, for the Super Bulls of Tesla who can see this outlier scenario or this rare setup, a lot of people also said, how about using your credit to pay for your debit? And the answer is yes, we have already evaluated that. If you sell for contracts of the Tesla bullish credit spread, sell 115 put, buy 110 put for Feb 17, 2023, you can clearly see that per contract you will gain $185. So just for simplicity's sake, you're getting about $200 per contract if you sell a Tesla bullish credit spread. Now, if you sell four contracts, that means 4 times 200, you receive $800. Now, how much would it be to buy a bullish debit contract for Tesla, saying that within the next month and a half or something, say 45 days, that Tesla can actually reach above 125 and you want to be on the bullish mode for that? You can actually basically use your credit spreads that receive here. Let's say you receive $800 here. You paid that $7 bullish debit buy for Tesla tonight. For every four contracts, this is one contract. Buy a 125 call and then sell a 145 call. You would have to pay about $7 thereabout. And your win will be about 1.2 to 1.3 maximum win, because this is a $20 with spread, or 125 to 145. Of course, if you want to expand this or make it 125 150, 125 155, or 125 135, the larger the with spread, of course, the larger the gain, but also the larger the pay, the debit pay that you have to do. So the reason why I did a 145 sell call is so that my max loss is just $7. Because if it's just a buy 125 call, it would need a risk of $14 or 1,400. Although the max gain there will be uncapped, because if you just buy a naked call, then definitely your maximum risk is how much you paid without a reward. So this is really a capped spread. For those who are aware, this is a debit spread, a bullish call spread. So this is essentially what it is. If you look at your Webull platform, this is your Tesla, this is your $122. So far, guys, for those who are in Webull, Webull Singapore app hasn't allowed multi-leg options, which we are doing here, which is we buy a 125 call, we sell a 145 call. That means a net debit of $7.15. That's a bullish debit spread here. Now, if you're going to make a bullish credit spread, that means you are selling the 115 puts and then buying the 110 puts, receiving that credit of $1.85. So if you want to fully finance your Tesla debit spread, you need to roughly sell about four Tesla credit spreads just to buy one debit Tesla spread for free. So 7.15 or roughly $8 divided by 2 is approximately you need four contracts. So it's not really perfect, but it's good enough to finance your bullish call spread for Tesla if you so want to do with that. Now, what would be your payoff diagram if you did that exact trade? Well, you need Tesla number one to be above 115 for your credit spreads to make money, for you to receive that 185 times 4, which is $715. Now, for your debit spreads to win, since you are paying $7.15 and your buy call is 125, 125 plus 7.15 means that you need Tesla to be above $132 for your debit spreads to make money. Now, if Tesla is below 115, how much would you lose? Well, you would lose the 315 times 4, right? So you would already lose 315 times 4, or 1,260. If Tesla is below 115, that means that Tesla is below 132, and therefore you would lose the total $715 spread there as well, which you've paid as a debit. So you would lose a total of $1,975 maximum loss, even if Tesla goes 80, 70, 90, $100. Now, if Tesla is below 132 but above 115, you would just lose zero. Why? Because your credit or your $715 received here pays for your debit. So plus 17 minus 715 equals zero loss. Now, if Tesla is above $132 before expiry or during expiry, you do gain the maximum reward. Well, you gain 1,285 if it is above 132, specifically hitting above your call of 145. So it has to be 145 or above. You gain maximum 1,285. But starting above 132, you will start to print money. So it could be $800 gain, 500 extra. That would be an extra gain. Okay. So yeah, so that would be how you'd make your credit spread of $715 become 1,285. You would have to use your 4 credit contracts to buy one debit. So basically, you are rolling your credit toward the debit spread. So you're just basically gaining $570 more if you do this. And you might want to do that only if you're really super bullish that Tesla can actually break above 132, reaching as high as 145 within the next 45 days. So it doesn't really have to happen within like 45 days, which is about roughly 5 to 6 weeks. Even on the next 3 weeks, if Tesla already is reaching 135, $140, you will automatically see your bullish place already set up money. So it's up to you if you want to actually take profit already, even before hitting your maximum gain of 1,285. So in general, a lot of people, they are okay to take 50% of the max gain. So if they calculate 1,285 as max gain, if they can get about $500, $600 profit, since they're not really shelling out any money, you'll notice that this is a zero shell out of your money because you are receiving credit and paying for that credit to finance your debit. So technically speaking, it's using the credit to pay, right? So yeah, it's not using your money. Although if you lose, as I said, your loss would be 1,975, which we also calculated here. Okay, so let's give you more ideas. Actually, on December 28th, I would already say that from a low of 104, some people already started to speculate on Tesla at 114. I was one of them. So I was actually saying that prior to last night for Tesla hitting 122, 114, some people have already been speculating around 110 to 114. Some people were already seeing that it was a positive day after several weeks of drop. So you could see that as long as Tesla is above 110, you or basically above 105, the bulls in the short term are of the winning side. So this is me. I actually sold 115 puts and then I bought the 110 puts. You can see that the net credit there is 2.06. So I received $206 for this Tesla bullish put spread. And I did the same here, la, la, la. So this is also a setup for the Tesla bulls out there. You can make an iron condor. You could see that you can sell the Tesla 115 puts, buy the Tesla 110 puts, the same thing here, procedure here. But also you can also make the same procedure on the upper range wherein you can sell a 175 Tesla call and buy a Tesla 180 call, receiving an additional $27. So instead of just receiving $200 or 185, you could win 212, but you could also lose $278. Your criteria here is you lose when Tesla is below 113 or if Tesla goes above 177. Anywhere in between, if Tesla stays within 125, 135, 150, you will win this $212 per contract. That is the iron condors when you are fencing and receiving credit for both sides of the stage, whether on the downside or on the upside. Let's give you more ideas since last night, indeed, a lot of bullish plays and bullish bounces. Tesla indeed catalyzed a lot of short covering last night. So you're seeing that Airbnb bullish plays is one idea that we can also do. If you sell 85 puts and you buy 80 puts and you also buy an 100 call, what is your risk and what is your reward? Well, you can see that if you sell 85 put, you will receive $6.80. If you buy an 80 put, then you have to shell out 4.75, which is $475. If you buy the 100 strike call, then you have to pay 235, which means that your total debit is actually $30. So you are paying with a risk cost of $30, but your actual maximum risk, guys, is really $530. Why is your max risk $530? It's because if your sell put buy put here could lose, you would lose about 500 bucks here. And since you paid 30 bucks for your call spreads, for your entire naked buy call for your Airbnb, you'd lose about $30 for that since you paid a risk of 30. So that's how you calculate your risk when you do this sell put buy put and then buy a call without a sell call alternative here. Okay, so how would you win? Basically, you win only if Airbnb is above $100.30. Well, Airbnb is 85 now. That might be quite a difficult thing to do. Now, below 100.3 but above 85, you still will lose 30 bucks. Maximum loss is just what you paid, which is $30. Now, below 80, you would lose maximum 530 bucks. Me, technically speaking, even if you could win unlimited when Airbnb goes above 100 bucks, it seems to be a very low probability payoff. So I would rather just sell 85 put and buy 80 put, just receive that. And you can see 6.8 minus 4.75 is already receiving $2.05. So I'm actually willing to just receive $205. No need to actually buy the 100 calls unless you just really want to finance basically some call options from your credit. So I usually don't do something like this. I just stick to bullish credit spreads wherein I just receive the money. So nagsabay-sabay nga lahat on the buying of the famous FANG names when Tesla got bought. Last night, we saw Apple bounce, Amazon bounce, Microsoft bounce, Google bounce. Therefore, the tipaklong Nasdaq QQQ, of course, bounces hard. These are the charts. You could see that in the short term, Apple finds a buyer here at about 125 to 130. You've got the QQQ getting covered at 260 to 266, which only means one thing. So if SQQQ will fall down from 58, where will it stop dropping or where will the market rally? The point is that the market's beloved fangs will therefore make your SQQQ fall. And this is your QQQ. So it fell from about near 295 to as low as 260. Yesterday, some short covering. Will this rally towards 280? And if it rallies towards 280, that means that your bear spreads on the QQQ will in the short term be negative. So you might want to actually profit take that before that happens, just in case. Now, a Tesla long will also mean a temporary ARC long. And for the moment, the $29 is protected. Therefore, you can technically make an ARC bullish buy 29 call and sell 35 call. That's just a bullish spread. And you can clearly see how that is done. You just simply buy a 30 call or 29 call and then sell the 35 call. How do you do that? You just open your Webull. Let's go for your ARC here. How much would it take for you to buy? The optimal setup is to use the 45 days to expiry. So here, Feb 17 is 49 days. That would be good enough. You want to be bullish on ARC. So what you're going to do is you buy the 30 call. So you pay $3.25 and you sell the 35 just to reduce your costs. So let's say this one, 3.3 minus 1.11, that would be 2.2. So your real risk is just $220 for an ARC bullish buy call. Buy 30, sell 35, that would be 200 risk and 300 reward. Because 35 minus 30 is a $5 with. Not so bad. It's a 1:1.5 type of risk reward. Okay, let's talk about more things here, guys. Let's go through our Digital turbine. So you can see last night some short covering, very strong rally in the past, 90% in just 4 days after earnings. You get that downtick or profit taking. And then last night's short covering made this rally back to 15. For those who are bullish on digital turbine, aka APPS, a simple way is you could buy the $15 or simply sell the 14 puts and buy the $12.50 puts. So you could sell the 15 puts, buy the $12.50, you receive 93 cents, or basically receive $100 for a risk of $150. This is quite an attractive bullish put spread to make, which is digital turbine. Can see that the maximum risk is maximum risk here is $3. So risk of 200 and reward of 93, 207 and then reward of 93. Not so bad. Now, due to the fact that yesterday marked a short-term bottom in the markets, we have more bullish spreads to make from the super high yield plays such as C Limited, Tesla, malaki, i.e. very high premiums are still given. And as a person who loves selling high IV environments, we might as well collect the premium. This is your C Limited, clearly seeing that 47 was actually an entry point at about $50. That was there was a gap up here based on the fact that C Limited was cutting expenses and becoming more operationally efficient. And you've got C Limited here getting retested at about 47 and 50. What is the way to handle this? There's two ways. You can make a bullish call spread, buy 50, sell 60, that's one, or simply sell the 45 puts and buy the 40 puts. So here, if you buy the 50 call, you'd have to pay up $7.25. If you sell the 60 calls for C Limited, just to reduce your risk, just to reduce your cost basis, then you have a total of paying $4.34. So you can actually try to bid on your C Limited bull calls at 4 below. So try to see if you can enter a C Limited buy. Buy the 50, sell the 60, pay 4. So maximum risk is 4. Maximum reward would be 6 because this is 10 minus 4. The width spread of 60 and 50 is 10. So pay 4, get 6. Now, this is Apple. We can do a lot of things for Apple. Yes, you could sell the 125 puts, receive $5. Buy the 120 puts, pay $365. You can also buy the 130 calls. You can pay that $7.45. And then you sell the 145 calls here and receive that 187. Your total spending for Apple out of all this, pay $515, receive $365, pay 5 plus 7. Sorry, I made a mistake here. Sell put, buy put. This is gonna be this is positive credit for you, yes, for this one. And then the buy call, sell call, this would be an outlay. You can see $7.40. Yeah, you've got to pay about $5.40 here. So total spending is indeed $4. So max loss would be about $4 or $400 for an Apple bullish spread. And then your maximum gain is as high as $1,100 simply because 145 minus 130 is a very big spread. That is $15. So you might want to actually trade Apple because this is a lose 1 and win 3 type of risk reward. So basically you're collecting credit here and then you're making a bullish call play here on the 130 area, similar to what we've been trying to do also with Tesla. Okay, yes, and this is your Apple. Very clearly, we can do this. So we are selling the 125. Again, we're selling 125 puts and buying 120 puts. There you go. And then you buy the 130 call for a sell at 145 call. This Apple trade I will likely do for tonight. This is quite an attractive risk reward. Look at Shopify here, also rallying last night at $35. For Shopify, it's quite simple. You could just sell a 35 put. You could see very high credits received, $3.65 for 45 days. That's a 10% yield. $30 here is giving a 5% yield at $1.69. So receive 3.65, receive $1.69. If you buy the 25 puts and buy the 22 and a half puts, you will be reducing your Basically, you're paying 68 cents here and 40 cents here. So your maximum gain, if you add this all up, would be $429, and your maximum loss is 1321. Reason being, sell put buy put here is a $10 spread. Sell 30 by 22.50 is a $7.50 spread. So maximum loss would be 17.50 since you receive 429. Therefore, your maximum loss is just $1,321. How would you lose money? Only if it is below $30.70, which means that your Shopify has to fall more than 15% down from here. And that means that you have a probability of profit of 69%. You might want to actually do this Shopify trade, quite a high probability game. For Roku, this is quite simple, same thing, very high yields. As you can see, if you sell the 40 put, you receive $4.75. Roku, you sell the 35 put, you receive $2.64. If you buy the 30 put and 25 put, just to lower down your risk, how much would your downside be? Max loss, 1423. As you can see, these are $10 with spreads, $10 with spreads, 10 plus 10 is 20. So that's a $2,000 maximum loss. But since you're receiving $577, 2,000 minus 577 means that your maximum loss is $1,423 for these 111 contracts. Probability of profit or payoff is 69% because the only way for you to lose money is for Roku to drop $5.77 or 40 minus 5 for it to go below 35 within the next 3 to 6 weeks. So we talked about just buying shares. There's no problem with that. I think time frame for a bear market rally would be about 1 to 2 weeks. So if you're buying December 30, you want to take profit between Jan 6 or Jan 13, somewhere within the next 1 to 2 weeks. For Amazon, you can create bullish calls and you can sell bullish puts. How do you do that? For an Amazon bull call, it's quite simple. You buy the 85 call, you pay $6. You sell the 100 call, you receive $1.41, which means that your maximum gain, your maximum loss since you've paid for it is 467. And the reason why your maximum gain is 1,033 is quite simply the width of the spread. This is 100 minus 85 is $15. 1,500 minus 467 equals 1,033. Now, for the Amazon bull put, how do you make money there? By selling the 80 put and buying the 75 put, you receive a net credit of $150. And because it's a $5 with spread, max loss is $350. This is your Amazon bull spreads that you could make. Up to you if you want to make a bullish call. Not so bad for that bullish call. And that is about nearly 1:2. And then for your bullish put, you can actually do the same, which is also about one risk. This one is risk 1, reward 2. This one is risk 2, reward 1. But the reason why the payoff streams are different is because the Amazon bull put would have about 70% probability of payoff, whereas the Amazon bull call will have less than 50% probability of payoff. Okay, so we want you to emphasize before the year ends, make sure that in the next year, taking profits is systemized, taking losses is systemized too. These are not arbitrary. The only arbitrary thing is you can take a loss if you really want to take it ahead of your stop loss. And sometimes you do that because if a stock goes against you, a price level gets broken. For instance, for others, if Tesla gets broken at 110, that would be a reason for them to take a loss. Earnings related, fundamental related, whatsoever. Most of the time, your profits and losses have to be systematically taken. Some people use a 50% profit rule to take profits. That should be okay. You should never override this unless you have a pretty good reason to do so. So let's say your system tells you to take 100% profits, but so far you only have 35 or 40% profits. Will you actually destroy your system and start buying for getting that 40-50% profit? You can do that only if you have a pretty good reason to do so. And why would you take profit ahead of a target zone? Number one, because you might be oversized in your bearish spreads. You're already seeing a bullish wave on a few growth names. And no matter how feeble this rally is, you want to take partially those profits, even if it's not yet 100%. Let's say you're just up 40% or 30% on your Hilton bear spreads or your whatever your bear puts are. Let's say you've got an Nvidia bear put, you're up 40-50%. You want to take profit even if it hasn't hit 100%. The answer is correct because you are getting because you are seeing that some stocks are already behaving in a positive manner. You may also do this because your account size bearish spread exposure may be too large, so you want to better take profits ahead of time. So let's say you've got more than 10% of your exposure in the bears, you might want to actually trim that to 5%, and that would be fine. So perhaps you're also unsure about the bearish put options that you've got. Either it's because of fundamentals or technicals. Some people were actually trying to be bearish in China, but with China reopening, they could actually be in danger for their Chinese shorts. If they're unsure, it's actually okay to actually try to close the position, whatever it may be. Whatever makes you unsure, while you can actually close that loss exposure for break even or less than 5 to 10%, might as well take that loss because it's just not okay to sleep well if you can't sleep well with your positions. So, example, you want to take profit on your shorts because the Nasdaq rose 2.5%, and I'm worried that my bear spreads with unrealized gains will have materially lower gains in the next week. You want to take profit before target. That is a valid reason. So those are actually some of the ideas. I don't want to bog you down, guys. I know it's a holiday. But definitely there's a lot of bullish put spreads and ideas that you can create in your account, whether it be energy longs, whether it be Apple longs, Amazon longs, Shopify longs. Those are actually interesting ideas, and you can rewatch this class whenever, wherever, until you realize that options bear spreads, options bull spreads, all of these are not hard. It just takes practice. It just takes a while to probably make it a natural language for you. But in the end, it's going to help you because spreads will limit your risk, very little outlay, and although cap rewards, it gives you realistic rewards. So that's it, and I hope to see you guys next year. That would be it for 2022, and hoping for a good new year for all of us. Again, my best Christmas gift and New Year's gift for everyone is mastery of skill. It's not a stock pick. It's not about whether, oh, you should buy EOG or FANG because energy bulls are going to go up next year. It's not going to be that. It's about the mastery and skill wherein whatever the market throws at you, you will be able to react very well, whether it's a sideways market, a bullish market, or a bearish market. Thank you very much and see you again next year. Have a happy holiday.